Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, I'm going to provide a summary of the key One Big Beautiful Bill Act tax provisions that went into effect last July. You've heard me mention this a few times on past podcasts, but I'm going to give you a quick summary again in light of the new tax season coming up for us. So that's the approach we're going to take on today's blog post. Before I begin, there's one. I'm going to show you a summary table in a second, but before I do that, I want to clarify. I do have a link on my blog post of a past deep dive where I explained the different key lines of a 1040 tax return. But one of the things that's going to be very applicable today is the difference between there's three different types of income from a tax return perspective. So you'll see on the screen right now, we're showing a graph of key lines. This is actually from a 2024 actual 1040 return. But I'm pointing out there's different levels of income. So there's total income, which is the line 9 that you see on the screen here. That's the sum of wages, Social Security income if it's taxable, investment income, et cetera. And then they have this adjustments from line 10. And then we have this new line called adjusted gross income, called AGI. That's line 11. And then you'll see we've got standard deductions and itemized. And then finally, after you subtract off those things, you end up on line 15 with taxable income. So there's income that you probably know it, your wages and stuff that you get coming in. There is this AGI that's commonly used for various limits, which I'm going to talk about today. And then finally, the taxable income, which runs through tax brackets, which is impacted by different deductions, which I'm also going to talk about today. So I wanted to show this to you. Again, reference my blog post for a deep dive on the summary of your tax return. But these lines in particular are very applicable today. So I wanted to give that as a brief refresher. So again, the One Big Beautiful Bill Act, it was passed in July of 2025. There were some provisions that were effective actually in last year, in tax year 2025. So when you're preparing your return this spring, you'll see how that impacted you, or maybe you'll be surprised by them. So that's part of the reason for doing this blog post. And then there's some new provisions in 2026. So on the screen right now, you'll see I have prepared a summary table of the key provisions. And I laid it out as a nice quick reference as you go through it, but just a couple of things to highlight on the screen. I break it up into personal provisions versus the business provisions at the bottom. So if it only want to focus on the personal, focus on the top. I also have the effective date. Again, I mentioned some of it was effective last year already, and other things were becoming effective this year in 2026. You'll also notice, too, I have an effective through date. Some of these provisions are permanent. They tax permanent to the extent that it takes an act of Congress to change it again. But other provisions end at a certain date. So most of them end, or if it's going to end, they end in 2028, as you can see. But there is one, the SALT provision, which I'll talk about, that actually goes through the 2029 tax year. So don't know why, but it's interesting to note. And then the next two major columns, the first two talk about what the old law was, and I show 2025 levels there, and then next to it what the new law is, and I did update it for 2026 levels. And so if you're wondering why there's a extra $400 or something like that, those are updated, excuse me, typically for inflation. So I updated those. And then finally, the last two columns to the right, these are different if it applies. Some of these provisions have income triggers, but as I just mentioned before, most of them are triggered by adjusted gross income figures. Not to confuse the issue even more, but that's the IRS for you. These are actually modified adjusted gross income triggers. There's about 6 or 7 different definitions, but for today's purpose, let's just go with AGI is a very good approximation. Not exact, check with your accountant, but today's purpose, let's think of AGI as our triggers that I list there. So that's a quick overview of the table that you're looking at and how it applies. So now what I'm going to do is, keeping this table in sight here, I'm going to first do just a brief reminder of those provisions that were effective in 2025. Hopefully you're aware of them. They open up some new planning opportunities for you. But if not, pay attention and make sure you use them or be aware of them in 2026 because they're still around until most of them at least until 2028 or longer. So the first one is the standard deduction. In the past, in 2025, it was 15,000 for single, 30,000 married filing jointly. So they added an extra 750 or 1,500 in 25 numbers, and then they just inflated it this year. So a little bit of a bump in the standard deduction, which is great. Take it. The next one, though, and this is a biggie. This is what's called the Social Security deduction. So for those people who are over 65 and over, there was an additional 6,000 per person deduction that was allowed. So this was related to, you might have heard on the campaign trail, maybe not making Social Security taxable. So they couldn't quite get that through the law the way they passed the bill. And so they added this extra deduction. If you look over on this table here at the right-hand side, though, there are income thresholds where you start to lose that benefit. So again, throughout this discussion and blog post here, I've got slashes. The first number is for single filers, and the one on the right is for married filing jointly. So this Social Security extra deduction, if you have income above 75 single, 150 married filing jointly, you begin to lose it. And it's for every dollar it goes over, I think it's 30. I'm not sure what it is, but as the amounts go over, you start to lose more and more of that 6,000 or 12 if you're married filing jointly. And then if your income gets above the far right there, 175 and 250, it goes away completely. So something to be aware of. Again, referencing back to that table, if you recall, these are AGI numbers. And so this extra deduction you're going to get, or if you're going to start itemizing, which I'm going to talk about in a second, that doesn't matter here. These are AGI numbers, and so these are before deductions. So Social Security deduction, big deal. It's going to be opening up some more room for people. Be aware of it. The other big thing was the SALT. It stands for state and local tax. Basically, think of state income taxes if you have them, and property taxes. So in the past, that was capped at 10,000, as you see on the table there. Starting in 25, they expanded that up to 40,000. In 2026 here, it's bumped up a little bit with inflation. So that is for those individuals who may not have been itemized in the past because maybe their property taxes and state were the biggies and they couldn't get over the much higher standard deductions. So now that's another opportunity. So check it out. A lot more people can now do that. There are some income limits, again, starting at adjusted for inflation now. 505,000 for both single and married filing jointly. There's a few times you'll see on the table where numbers apply to both, and this is one of them. So check it out and pay attention to your potential itemized deductions this year and next year, forever. Or I guess this one this one does go away after 2029. So I guess you got a few more years to take advantage of it. Child tax credits. If you have children, they have bigger provisions now. So that is now up to 2,200, I believe. Yeah, 2,200 per child. There are income limits, and so look at that to make sure if they still apply. Manage them if you can. The income, definitely manage the kids. And then finally, on the personal side, there's a few miscellaneous deductions. If you have tips, overtime, new car loan interest, read the details if it applies to you. Some new provisions that were effective starting in 25, so check it out. There were a few provisions on the business side as well. So at the bottom of the table, a lot of them were actually effective last year. And some of them, there was even one that was retroactive on this bonus appreciation. But the 3 or 4 biggies there. So one, we always had this QBI and pass-through entity provisions. So they basically kept it in place and made it permanent. So there's a chance that it could have gone away. So that's now permanent. There's 100% bonus depreciation. That is one where they backdated it. So a law passed in July 4th, and they backdated that to early January. This qualified, so QBSB is how I know it, this qualified small business stock exclusion. For those individuals who may have stock, if you work for a startup company and you were granted options or small stock, check it out. There's a provision if the company meets certain requirements, you may be able to exclude a large portion of that capital gain. So be aware of it and check it out. And then finally, this is a provision I thought was not effective until this year, but I confirmed it was effective on July 4th, and that is farmland. So you have to meet certain provisions. It has to be in farmland use for the last 10, expected and documented that it's going to be used for farmland for the next 10, you can spread out the capital gains of that sale. So, farmland has been appreciating quite a bit. Big capital gains do potentially, likely. So if you satisfy some rules and you document it, you can spread out the payment. You can't lower it, you can't get rid of it, but at least you can spread out the payment of those capital gains for 4 years. So that is a quick summary of the 2025 provisions. And so there's a lot there. The good news is those continue on for a few more years, so make sure you check them out. And if you missed some of the planning opportunities, make sure you go back and try to take advantage of them this year. Again, common thing is these AGI, let's call it triggers. If you were close, there are some things you can maybe do to lower it, to pick up more of the deduction, or maybe you weren't aware of it and you did a Roth conversion, you kind of blew yourself out of the water. Be aware of it and just consciously do it this year. So check those things out. If you're 65 or older and you want to get that lower AGI, the main lever you have to pull is maybe doing your charity out of an IRA instead of a just direct. It's called the qualified charitable distribution. If you're under 65 and you're trying to grab some more of that salt, one of the things you can do is make sure you're taking advantage of deductible 401ks and HSAs and some individual IRAs. So a couple levers each individual could pull. Just be aware of it and make sure you do that planning here in 26. In addition to that planning, there are some new provisions coming up. So we're going to throw the chart back on the screen again, and you'll see now the 2026 provisions that are going to come into play. So the first one, this one, it's good for some and bad for others. And so charitable deductions. So if you do not itemize, so even though you had this new SALT in place, if you're maybe you're retired or don't have state income taxes, maybe you're always taking the standard. If you're not itemizing, just taking the standard, in the past, you couldn't get any tax benefit for a charitable deduction. Starting in 26, you are allowed to have up to $1,000 for single, $2,000 for married, filing jointly. The key is, though, it has to be a cash contribution. So it can't be property. It can't be the stock donated. It's got to be a cash contribution, but you do pick up an extra deduction that wasn't available if you took the standard deduction in the past. On the negative side, that took away a little bit. Those individuals who do itemize, including charitable contributions, you have to exclude the first 0.5% of your MAGI. So if you made a contribution, take 0.5% of your AGI, you got to subtract that off before you can add that to your itemized pile, if you will, for charitable. The other thing, this was something new. Wasn't aware of it last year, but became aware this year. If you do itemize, so it's great. You got this itemized deduction, and the benefit to you depends upon your tax bracket. So if you're in the 24% marginal Fed bracket and you're itemizing, that's the benefit you get. You save 24 cents on the dollar with your itemized deductions. If you're in the 35, you save 35%. Well, in the past, if you're in the 37% marginal, you got that full deduction. Starting in 2026, the most you can offset with deductions, itemized deductions, is the 35% rate. So they're kind of again, they had to squeeze the rock, if you will, to get some water out of this for revenue. And so this is one way they did it, capping it at 35%. What else? Estate tax exemption. So these are all numbers I'm rattling off at the federal level here only. Normally, there was a chance that the federal exemption could have gone away. The OBBBA bill made it permanent. These are permanent changes that I'm talking about here. Normally they adjust it for inflation, but this year they bumped it up to 15 million flat. So and that is per person. So at the federal level, you can share it amongst couples. So that gives you 30 million if you're a couple, 15 single. So that's a nice bump. It's about 2.5 times the normal rate that you would have received if they just would have gone with inflation. One quick aside there: if you be aware, there are some states have estate taxes, and so this again only federal. Here in the great state of Illinois, we have a 4 million estate tax exemption. So be aware of it. We don't get portability, so each state can be different. Just be aware of it. What else worth noting? I guess 2 more things on the personal side. One is the some 529 changes. So this is a college savings plans. Again, federal level, they changed the dollar amount you can use. In the past, you could use up to $10,000. to pay for K through 12 tuition. And so starting in 2026, that number can now be 20,000. So that's good. Be aware, that is at the federal level. At each state, they have to also pass a state rule or state law, I guess, to make it effective for that state. So definitely you got to save federal taxes if you use it, but just be aware you may not get all the state tax benefits unless your state explicitly passed this law to reflect that. And then the last thing, just to mention on the personal side, these Trump accounts. And so you may be thinking, well, wait a minute, Kirk, I thought that was for kids born and starting in 1/1/25, and that's true. However, the actual implementation, opening, how the hell is this thing going to work? That's starting in 2026, probably not until mid 26. But anyway, so that's why I put it on this effective year, because that's when you can actually start using them. But again, main requirement, you have to have a child born between 1/1/2025 and 12/31/2028. If you do, you open up an account, follow some rules, and the government kicks in $1,000. You're allowed to put in more each year, but read some past blog posts on that. There are other choices that, in my opinion, are probably better for you. But if you've tapping out all that stuff and want to have one more tax provision, check it out. So that is the quick summary of the personal tax deductions. And now there's actually just one that I'm highlighting here. Again, there's this OBBBA bill was big and beautiful, but it was big, as I said. So this isn't a summary of all of them, but it's just things that caught my attention. And that is for 2026, the business provision here is employers are allowed to create education assistance. And again, read all the rules of what all applies. I know one, as an example, is if the employer pays a portion of student loan payments, that's considered a qualified educational assistance. Employers can deduct, and employees don't have to include in their income, up to $5,250 if your employer gives those. And so new planning opportunity for businesses, I guess small businesses and large, if you want to enhance the benefit package to make it more attractive for your employees. So that is a quick summary of the key OBBBA provisions. And so again, some of those you're going to see the effect of them as you're preparing your 2025 return. If you say, gosh darn it, I missed out on that one, make sure you're aware of it this year and do some planning around that. And then, of course, the new ones for 2026 could help you. Or if it doesn't help you, but you think of people who might apply to, make sure you make them aware. So I hope this refresher was beneficial. I know it's an exciting topic. Who doesn't want to save money on taxes? So make sure you're aware of the changes. Make sure you go out and claim the benefits that are yours. All right. That's a wrap on today's topic. Thanks a lot. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.